The 4% rule comes up quite a bit when we talk about financial planning. Can you explain that and tell us whether that still applies in the world today?
The 4% rule is really a back of the envelope, easy calculation to see if you're on track for retirement. And really all you're doing is saying, take your total investable assets and multiply that by 4%. That is what in the past has been considered a safe distribution rate for the portfolio. If you have $1 million, that is $40,000 that you could take from the portfolio each year, weather the ups and downs of the market, also keep up with inflation. So the 4% rule came about in the 1990s. And if you think about the time period where they were probably doing all of this analysis, that was the late 80s. And the late 80s was characterized by the 10-year treasury being at about 6.5%, maybe a little bit higher, and inflation being pretty consistently in the fours. And so where you were able to have reasonable returns from bonds, and then inflation started to go down in the early 90s, that's where 4% really seemed to make sense. If you fast forward to the 2010s and coming out of the great financial crisis in 2008, interest rates were consistently low for almost a decade. And during that time, people started to say the 60-40 stock to bond portfolio is dead, and the 4% rule, probably more like 2%. And the reason for that was inflation was low, but also interest rates were low. And so couldn't earn much on bonds. And that really impacted the thinking around the 4% rule. If you fast forward today, the last 3 years, we've been through a very volatile interest rate environment, and we had interest rates at zero during COVID. Now interest rates are at a point where they're at reasonable levels historically. The 10 years at about 4.25 today, and inflation is starting to go down. So the 4% rule becomes a bit more relevant. Obviously, it goes without saying that if you take 1% of your portfolio, assets will last longer. But it's pairing what's realistic, what are your income needs, and that's specific client by client. But obviously, the less you take off your portfolio, the better chance you have of not running out of money.